Hello and welcome to our latest Insider interview. Today in the studio I have with me Samantha Fitzpatrick, co-fund manager of the Murray International Investment Trust. Samantha, thanks for your time today.
My pleasure.
So Samantha, let's start off with your investment process and objective. So you invest in global equities, you aim to deliver an above average dividend yield, and you're also aiming for overall total returns to beat inflation. So how do you achieve those objectives?
Yep, it's really important that we do address both because people associate the trust very much with the income angle, but we want to deliver real returns over time from a total return perspective also. And that means it's really useful to be able to truly use the global remit and invest in lots of different types of businesses. So an above average dividend yield typically means about 4.5%, but it's not the case that every single investment has to deliver that level of income. What we can do is operate more of a barbell approach. So you have certain companies that are there predominantly for the income, they're really consistent payers, but that gives you then the flexibility to go a bit further down the yield spectrum and other types of companies that perhaps can deliver more upside from a capital perspective. Sometimes you're really lucky you get both from the same stock, but that's how we approach it overall.
And could you talk through what the main qualities or attributes you are seeking in a global business in order for that company to win a place in the portfolio?
Yeah, as much as I say that you'll get companies that are tilted more one way or the other, we want every single investment to contribute towards that income perspective. So that would be an obvious screen we would do on an income, a pair. It doesn't have to be huge, but it's got to be something. And what we want is to see evidence of growth in the dividend over time. So again, that gives you confidence to invest perhaps in a lower yielding name, but with that potential over time. And other aspects, it won't be any surprise to people, we want companies with strong balance sheets that enables that dividend to be paid year in, year out, hopefully. We want companies with well-established management teams and that hopefully have been through difficulty in the past, and you can see how the management team copes with that.
As you've mentioned, the portfolio isn't full of high-yielding businesses in order to achieve the aim of having an above-average dividend yield. However, could you name some of the companies in the portfolio today that are among the highest yielders?
Sure, there's a real mix actually. So you will get in the trust companies that do deliver consistency on the income side. So that's typically some of your telecoms names, for example. We own TELUS in Canada, for example, which is paying about a 7% dividend yield, very consistent. And then you will also have at times more cyclical names that are in a sweet spot that they're paying out quite a lot of income to shareholders in that way. So even at the moment, we've got names such as Woodside Energy, a predominantly gas energy company in Australia that has cut its dividend, but it's still on a 9% dividend yield. And then you get other names that are perhaps a bit more vulnerable on the dividend side, something like Taylor Wimpey, for example, in the UK, that as things stand are on a 7% dividend yield, but that's because the share price has come down quite a lot in that name. So we go into that with an open mind. We know that perhaps next year it could cut that dividend, but as things currently stand, that's examples of three very different businesses that right here, right now are offering a high dividend yield.
In terms of country allocation, you've had a long-standing underweight position to the US stock market. That remains the case today. Around a third of the portfolio is in US shares. However, I did notice that you have been increasing some exposure of late. You've introduced a couple of new positions. Could you talk through them and explain why?
Absolutely, yes. So it's not that we're against the US. Sometimes people can get the wrong impression. All the weightings are a result of where we're seeing stock opportunities with an eye on diversification at all times. But recently, you're right, we have introduced a couple of new US names, one of which is Lowe's. So a company that we wouldn't be familiar with here in the UK, but it's the second largest home improvement store in the US. The biggest one is Home Depot. And the idea behind investing in Lowe's is that it is really closing the gap with the best in the industry. Home Depot is the best. If you look at returns, if you look at performance, that's the one that they have to get closer to, and they have done that. You can see evidence of real margin improvement over time. And partly That's to do with a new management team coming in from Home Depot, so they've done it, they know how to transform this business, get more into the professional customer rather than your kind of typical DIY player, because it means that that type of customer tends to spend more and come back more often. So they've made huge strides in actually closing the gap with its bigger peer. The thing that held us back from Lowe's before was that it's not a terribly big yielder. It's about a 2% dividend yield, which for us is quite measly. But how we got around that is by funding it from some other stocks that were even lower. So some of the tech names just now, for example, are really low yielders because the stock price has been so strong in some of these names. So we got around that issue by top slicing some tech and putting it to work there. So still income uplift, but giving you a different type of business in the portfolio, which is useful. Other names I could mention at the end of last year are things like Coca-Cola. So just a really steady quality company, good yield. That had been quite weak on the valuation side because it was caught up in the GLP-1 story. So some would have you believe that if people go on weight loss drugs, they're not going to touch anything that's a treat anymore. And we think that story was vastly overplayed with the likes of Coke back in like December last year. And the third one that is a relatively new holding is Medtronic, a US company still in healthcare, but something a bit different, some more medical devices rather than purely pharma. And since we introduced that one, it's performed really pretty well. So a range of different businesses in the US.
It's not uncommon to see a global fund or investment trust only invest in developed markets. However, Murray International does have a good amount of exposure to the Asia Pacific and Latin American regions, which combined account for around a third of the portfolio. Could you summarise where you're seeing the opportunities in those markets?
Sure, we just think, why would you not look everywhere? You know, we've got a range of different people, analysts going to meet businesses all the time, and we're presented with really good stock ideas. So we want to use that global remit as best we can. And we do have, as I say, people on the ground in Brazil and in Singapore and all these different markets, and they know these businesses. And often what we find is you get really good opportunities, but a lot cheaper than you could if you were just limiting yourself to developed markets. So it's really about just trying to spread that exposure and treat them not as anything different. They're not getting special treatment by any means, but if they stack up from a quality perspective, if we like the management team, if they can deliver something a bit different and help with that income story, then why not?
You mentioned earlier that you've took some money out of technology. It does, though, remain a key sector within the portfolio. Could you talk through the opportunities you're seeing and the trends that you're investing in within the technology sector? Sure,
we got a bit lucky with tech, to be honest with you, because one of the biggest holdings we have at the moment is Broadcom, which is really hitting the headlines for all the right reasons. It's an AI story. But when we went into that several years ago now, it was for more of a yield angle. It was a 7% dividend yielder when we went into that one. It was a good business, but it was a business that was involved in different areas. It was a company that bought other companies and improved them, and that's still part of the story. But we do have some AI exposure, as I say, through Broadcom. We have TSMC, Taiwan Semiconductor, which is exposed to semiconductors, but really, really well diversified. So that one, I think, is a fabulous company. It's a really cutting edge company that makes chips for other people. And no one else can do what it does to the scale that it does it in. So that's another big holding within tech. And then we have tried to broaden our exposure. So we had mostly all of our exposure in tech within semiconductors because we could make the yields work there. But very recently, just a couple of months ago, we introduced Infosys into the trust. So one that had been on our watch list for a while, and this is different. It's an Indian-based company, but it's global in terms of its remit. And it produces more consultancy, more services, so giving you a different angle, not hardware. We've got a bit of that in Cisco. So what we're trying to do, again, within tech is not just be a one-trick pony. You know, the AI stories work very well for us, but we're very aware that semis are cyclical, you know, and AI, I think, could prove to, you know, to have some ups and downs. We've seen that a bit so far this year. So trying to have a broad range of exposure within that category makes sense to us.
Samantha, thank you for your time today.
You're very welcome. Thank you.
So that's it for our latest insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment. If you enjoyed it, please hit the like button and do hit the subscribe button for future fund manager videos. And I'll hopefully see you again next time.